Good afternoon, everyone, and welcome to our BlueKey Market Review / Outlook. Today's July 23rd, 2016. This is our third quarterly webinar. Today we're going to review the first half of 2016 and take a look forward. So it's been quite a ride for the year. We started off with a big sell-off, down 10.5% through February 11th. From there we had a rally up about 15% through June 30th. Overall, for the first half, the S&P 500 was up 2.69%. Including dividends, it was up 3.81%. And then since then, it's risen even more. So far, it's been a pretty good year for the S&P. Taking a look back at the year, and you look at the left side of the screen, we started off with quite a scare. In China, there was lots of problems. The currency, the yuan, was dropping quickly. That led to fears that there would be problems around the globe. In addition, in China, the Purchasing Managers Index was falling. So there was threats of a worldwide recession. Oil prices were declining and getting lower and lower. And Trump was starting to win some primaries, so people were beginning to take this guy seriously. Japan adopted negative interest rates toward the end of January. That also added to fears that there must be something seriously wrong with the world economy. Right around February 11th, the market hit bottom. We continued to get strong jobs reports throughout this whole period. And if you carefully looked at the data, and I think we spoke about this in our January webinar, we didn't think the U.S. was in serious threat of going into recession, and that turned out to be the case. We had strong jobs reports. On February 11th, Jamie Dimon, CEO of J.P. Morgan, stepped up and bought $25 million of his own stock at JPM. And OPEC also at that time indicated they might get together and cut production a little bit to help with the price of oil. So the market rallied from that point forward. China indicated that they would get their currency under control, and the Fed, which had gone into the year anticipating 4 interest rate increases, realized they were going to have to back off and started saying that maybe they'll have 1, possibly 2 at the most. So they were going to be supportive. That all helped the market. Price of oil continued to increase. And at this point, fears of recession really were fading as we continued to get solid jobs reports. That helped with the market rally. Trump had a big win in New York and pretty much wrapped up the Republican nomination at that point. The market began to sell off, but the economy was continuing to do pretty good, and the Fed was starting to talk about an interest rate increase in June. That was leading up to the Brexit vote, and in the days before the Brexit vote, the market increased, expecting that UK voters would choose to remain in the European Union. But that's not what happened. They voted to exit. There was a panic sell-off. Market went down, but it couldn't get any lower. And from there we had a big rally, and it's continued up since then. So if you look at the different asset classes, so far this year, REITs have been the big winner. And you look back several years, REITs have been a very powerful asset class and have done very well. Commodities, way up this year, plus 13.3%, and that's a huge reversion to the mean trade. If you look from 2012 to 2015, that was the worst performing asset class. High yield and emerging market equities all up, indicating that really for the year as a whole, risk on has been the preferred trade. Looking at returns by style box, in the first quarter, pretty much everything was up except small cap growth. Q2, everything was in the green. And you look for the first half on the left side, all the value sectors did terrific, and small cap value was the big winner. And all of that is the exact opposite of what happened in 2015. International returns Going down to the bottom, we'll just look at the entire first half of the year. Overall, pretty much flat, plus 0.11%. Emerging markets were a huge winner, plus 8.56%. And here we're looking at the returns of some Vanguard ETFs to measure these international returns. Pacific was down a little bit. Europe was the loser, minus 4.6%. And of course, Brexit didn't help with that. Sector returns for the year, pretty much everything was in the green. Energy was the big winner at plus 14.74%, and utilities, an incredible increase of 23%. As interest rates go down, investors flock to utilities. That sector is pretty pricey right now. The only loser were the financials. They were down around 5.9%. Looking at fixed income, emerging market debt denominated in local currencies, we're up 14.3%. And emerging market debt denominated in US dollars, up 10.3%. High yields, plus 9.1%. Commodities have had an incredible year. Gold up 24%, silver up 35%. Base metals up 15%. You can see in previous years how it's pretty much been all in the red. Still, if you look over to the right, since 2011 and 2013, all commodities are way down still. So going forward, we'll take a look at the U.S. economy. We'll talk about Brexit, China, the world economy, oil, the Federal Reserve and interest rates, the presidential race. Take a technical look at the market and see where we are in terms of valuation. So let's take a look at the U.S. economy now. And on the left, the chart is the Atlanta Fed's GDP now, which gives kind of real-time estimates of GDP growth for each quarter. So we're looking at quarter 2, and the current reading is plus 2.40% growth for the second quarter. And if you look at that green line on that chart, you can see it's been pretty steady throughout the entire quarter, right around the 2.5% area. Now in Q1, the actual growth per the Fed was 1.1%. So Q2, we've had a nice increase, at least based on the estimate. Off to the right is the New York Fed's nowcast, which, similar to the GDP now, but using a different methodology, comes up with an estimate for Q2, and the New York Fed is at plus 2.2%. So both numbers are looking at plus 2% growth for the quarter. That's an improvement from Q1. Clearly, we're not in recession territory right now in the United States. If you take an early look at Q3, which the New York Fed has, they're anticipating 2.60% as of July 15th. That was their last calculation. So Q1, we were plus 1.1%. If you take an average of the New York Fed's nowcast and the Atlanta Fed's GDP now, you're at plus 2.3% for Q2, and the early number on Q3 is 2.6%. So the trend in the United States is positive. Let's look at some conditions that often precede a recession: accelerating inflation, inverted yield curve, rising inventory to sales ratio, and rising jobless claims. If you look at accelerating inflation, the trend is still down. Looking at an inverted yield curve, we do not have an inverted yield curve at this time, although the curve has flattened. Off to the right, an inverted yield curve would be less than 0. So right now we're still positive. We don't have an inverted yield curve. And what an inverted yield curve means basically is that the short-term part of the curve, the interest rate would be greater than when you go out. So the chart on the right compares the 10-year Treasury bond rate versus the 3-month rate. Rising inventory to sales, that continues to be a yes. We've looked at this chart all year, and it's been yes all year, although it's ticked down in the last couple of months. Rising jobless claims, no. This continues to be the strongest part of the U.S. economy. And in today's Barron's, also spoke about this. It says that virtually all recessions are immediately preceded by an increase in new unemployment insurance claims from the same month a year ago. and as of the most recent reading, it's down 7%. We don't think right now we have the conditions that precede a recession, so we think the U.S. economy is in good shape for the next 6 months or so. Looking at Brexit, this had an impact around the world. Nobody expected Brexit to pass, even the people that were pushing for it, so there was a complete lack of preparation. It was like as soon as they voted to exit, the question was, okay, now what? They had to figure out what they were going to do. This is definitely a short-term negative for the UK. There's just a lot of uncertainty. There's a whole 2-year process to negotiate and figure out how things are going to move forward. We would like to point out that we don't think the Brexit vote was really about free trade. If you listen to the current leaders in the UK, they definitely want to keep free trade. They understand the importance of that. They even want to enhance it around the globe. So they're hoping that they can negotiate favorable free trade terms like they had before when they were in the EU. What the vote was really about was restricting and getting control of immigration. So short term, it's a negative for the UK. Longer term, not really sure yet. It'll probably be a negative, but a lot depends on how the negotiations work out. Worldwide, there is going to be some kind of impact, but it's not going to be a huge impact. The UK represents about 4% of the world GDP and about 3% of global GDP growth. The result of Brexit has pushed the US dollar higher, and that's going to hurt earnings in the United States as well as hurt exports. So most US growth forecasts have declined by about 0.5% or so for the remainder of 2016. The big risk is that there's going to be spillover, that there might be other countries that say, hey, if the UK can leave, why can't we leave? And that would lead to more problems in Europe and around the world, which also could lead to some unintended consequences. So now let's go on to China. The concern is that if China slows down a lot, that's going to hurt the entire world economy and possibly set off a global recession. Or if the currency devalues, that also would be a big problem. That would lead to a drop in Chinese imports, an increase in Chinese exports, and it would impact debt denominated in US dollars. So you got to remember with China, everything is controlled by the government, or the government at least tries to control everything. So they're going to do whatever they can to maintain social stability, and that also means to make sure that GDP continues to grow. So looking at the value of the currency, and we're looking at this because this set off the market sell-off at the beginning of the year. We did have a rally from the beginning of February going into the end of Q1. Since then, the yuan has sold off, and it's kind of gotten some cover from all the news about Brexit over the last few weeks, but the currency is definitely down. We're going to have to keep an eye on this to see if it continues to depreciate. But if the market, if the yuan falls quickly and the market doesn't anticipate it, that could be a trigger for another market sell-off here in the US and around the world. But again, remember, this is a political issue. This would hurt China, not only domestically, but overseas. China's in the middle of a lot of controversy with Trump and even with the Democrats. So they're going to do everything they can to keep the valuation of the currency very orderly. Ironically, the Chinese currency is probably overvalued, not undervalued, and China's doing everything it can really to keep the value somewhat up, which is the exact opposite of what Trump and Bernie Sanders and that crew basically tell people. So let's look at growth in China. This is the Caixin China Purchasing Managers Index, and for manufacturing it fell to 48.6. Now break even is considered 50.0. Above that you're considered in growth mode, and then less than 50 you're not growing, you're contracting a little bit. So manufacturing is less than 50, so that's contractionary, but services increased to 52.7. That was the quickest increase in 11 months. And composite services and manufacturing fell by 20 basis points last month, but it's still positive, still above 50, indicating very slow growth just above 50. So what does that mean in terms of GDP? So you look at the history of China's GDP versus the Purchasing Managers Index, and if you're right around 50, that translates into GDP growth in China of a little bit less than 8%. And you look at the official Chinese number that came out last week for Q2, it shows growth of 6.7%. So right now, growth continues in China. So the big risk here is that the currency just falls out and depreciates a lot quicker. It's a surprise that will definitely, or most likely, hurt equity markets around the world. Chinese growth, as we just showed, continues in like the 5 to 7% area. But a lot of this growth is being financed by huge debt the Chinese government is taking on. Now they're investing most of this debt in infrastructure, so hopefully this will be a productive investment and pay off in the future. And again, remember, China is going to do whatever it can to prevent social unrest and try and control growth and control the currency. So right now, China has been pretty steady and has not negatively impacted the world equity markets. Looking at the rest of the worldwide economy, the global composite purchaser managers index was at 51.1 for June, so that indicates some slight growth. Manufacturing PMI was above 50 at 50.4, and the services PMI is at 51.3. For the entire quarter, the composite PMI was at 51.3. Normally you get a recession worldwide when the PMI is less than 50. So at least as of now, we're above 50. We seem to be avoiding recession around the globe. What is going to be the impact of Brexit? The IMF, which is forecasting growth of 3.1% and 3.4% in 2017, those are the most recent numbers, they cut their numbers down by 0.1% due to Brexit. So that's what they think the impact will be. Moving on to oil. Oil has had a nice rally since February 11th. That has helped the market, and it's also helped the high yield market. So as the price of crude oil has recovered, you can see that high yield spreads have declined a lot. So the quote junk bond markets are feeling much better about high yield at this point. So the threat of contagion from energy defaults, that was a big worry in the first quarter. Everyone thought, or a lot of people thought, that if with all the energy defaults, and there are many, they felt that would spill over to the rest of the high yield market. That did not happen. So the threat proved to be contained, and the high yield markets have rallied since then. Energy prices have fallen over the last few weeks from about $49 to $45, but they're still up since February 11th. We think prices will stabilize from this point, somewhere in the $50 area, maybe get up to $60 here and there. If you look at the production in the red box off to the left, you'll see in 2015 we were adding about 1.9 million barrels per day that year, as there was just a mismatch of supply and demand. But in 2016, it's down to about a million barrels per day, and in 2017, it should pretty much break even. So supply and demand should equal out, and that will help stabilize prices, should help also the high yield market. Looking at the Fed, at some point, interest rates are going to have to increase. A couple of weeks ago, we hit an all-time low on the 10-year Treasury. It dropped to about 1.37%. And the consensus at that particular moment in time was that Treasuries would continue to decline in yield. That's not what happened in the subsequent week or two. Treasury yields moved higher. So let's take a look back at how we started the year. If you went into the year in January, the Fed was talking tough. They were talking about 4 possible rate increases during the year. That dropped down to 2 as we had trouble in January and February. And then when we had a really negative jobs report in May, it looked like there would be no increases for the entire year. Now though, as the market has rallied over the last several weeks, and also as the U.S. economy has done pretty well, there is talk that there'll be 1, maybe even 2 hikes this year. So we'll have to see where that goes, but we think there'll probably be 1 hike after the election. Other things that are going to increase interest rates down the line, the Fed has a portfolio of $4.2 trillion in securities. The normal level is about $1 trillion. So somewhere at some future point, the Fed's going to have to sell off that inventory. That'll increase supply, and that will most likely increase interest rates. Another issue is fiscal stimulus. Both Clinton and Trump are talking about stimulating the economy by spending more money. So most likely that won't be absorbed by the Fed. So that's going to be another increase in supply. And then if the labor market continues tight, if unemployment continues to fall, and if we continue to see increases in wages, the Fed's going to have to act on that. So we think the 35-year bull market in treasuries has come to an end or is close to coming to an end. Not that that means there's going to be a drastic increase in interest rates in the near future, but we might have reached the bottom in terms of low yields. One factor that is going to be a negative on the markets is presidential uncertainty coming from both the Democrats and the Republicans. You know, in regards to Clinton, it seems that she's moved a little bit to the left based on the impact of Bernie Sanders. And then on the Republican side, you have Trump, who at times has gone further to the left than even Clinton. So there's uncertainty regarding what's going to happen with tax policy, immigration policy. Neither politician is addressing really the biggest issue in the United States, which is the long-term structural deficits, mainly Social Security. So that's going to have to be addressed at some future point. Our biggest fear is a trade war. When Trump says that he's not worried about a trade war, when he's talking about big tariffs with China or Mexico, we think that could really hurt the market. The last time that was tried, going into the Great Depression with the Smoot-Hawley tariffs, it really didn't work out so well. The market dropped 10% on the day that Smoot-Hawley was passed. World trade subsequently dropped 67%. Imports into the U.S. dropped 40%. U.S. exports fell 75%. And unemployment increased from 6% to 25%. That turned out not to be such a good idea, and we think that's a real threat to the market if Trump were to win the election. We showed these slides at the last webinar. You could read them at your leisure. These are two studies that show what the possible impact would be of a trade war. We do think there are some legitimate issues that have to be addressed in terms of like stealing intellectual properties and possibly unfair government subsidies, but we think those issues should be handled individually. The threat of a trade war is not going to be good for anybody. This is a chart that we posted at the last webinar on April 13th, and our main point here was that to establish a new uptrend, the S&P 500 would have to get above that white declining trend line that you see in the upper right. And that's what happened. In early April, the market did break through. However, it couldn't hold, and it fell back down. Then again, it broke through in May or June. Brexit dropped it all the way down to that support line. And then finally, in the last few weeks, we broke higher, and it appears to be a clean break. Right now, the biggest thing the market has going through it are the technicals. After a long sideways consolidation, and the consolidation lasted almost 18 months, and you have a clean break higher, often you'll see a pretty good run higher from that point. There are a lot of other technical indicators that are in the market's favor. Breadth, which is a measure of the percentage of advancing issues, has been really high, and that's favorable. Percentage of stocks above their 10-week and 40-week moving average are also high. When you have a series of lower highs on the volatility index, on the VIX index, that's a bullish signal. And the financials, the banks, have been performing a little better. When you see these kind of indicators, those are all bullish signals that the market has further room to run. On the flip side, this is a table of corrections of 5% or more that we keep. This dates back to 2005. So far this year, we've had a correction of 13.34% and one of 6.01%. The average over this time period has been about 2.27 per year. Right now we've had 2 this year. However, given all the political uncertainty, given the Fed, given Brexit, all the geopolitical risks with everything going on around the world, we definitely think there's a chance that there could be another correction this year. So you have to keep that in mind. Looking at earnings, we have been in an earnings recession for sure, even though we're not in an economic recession. Earnings have declined for the past 4 quarters, and they're expected to decline this quarter, which would make it 5 in a row. So if you look off to the right, as of March 31, earnings for this quarter were expected to decline by 5.5%. On March 31st, the expectations they would be down 2.7%. As we've gotten the earnings reported so far for a bunch of companies in the first couple of weeks, they're coming in a little better than expected. So probably for the quarter it'll end up being down like 2% or so, but it's still going to be negative. If you look at Q1, earnings came in at minus 5.2%. They were anticipated to be negative 9.1%. That's as of March 31. Came in better than expected. For Q3 and Q4, right now Q3 is expected to be about break even, and then analysts are anticipating in Q4 that earnings come in higher, plus 6.6%. But that's down from the 11% anticipated increase as of March 31. For the entire year, earnings are expected to be about break even, and revenues should be plus 1.7%. One of the reasons that earnings have been down, you look on the chart, we just circled it in red, you'll notice profit margins have been declining as payroll has been going up. So labor's share of income has been increasing, profit margins have been declining. And then the sectors that have really hurt the market are energy and materials, and both those sectors are related. Everyone knows the reason. Energy is down, but that has pushed profit margins into a minus territory, and that's had a huge impact overall. In terms of valuation, this is the reason that many people are arguing the market is dangerous here. Valuation based on traditional metrics like price to earnings, price to book, price to sales are at highs. Not as high as they were, let's say, in 2000, but they're pretty high at this point. So if you look at this chart, you'll see that the PE, this is the forward PE, looking at anticipated earnings over the next 12 months. The PE ratio is 17, the 5-year average is 14.6, and the 10-year average is 14.3. So these are reasons why you would want to be cautious on the market based on traditional metrics. If you look at Morningstar's coverage universe, these are stocks that Morningstar rates, that their analysts actually follow, and you measure the price of the stock compared to what Morningstar considers to be its fair market value, you'll see the ratio is 1.03. So that would indicate that the market is just a little bit overvalued based on this metric. And again, this is the median stock in the coverage universe of all the stocks that Morningstar analyzes. So it's not wildly overvalued, just a little bit, by essentially 3%. Here is the big argument on why the market is fairly valued or even undervalued. If you look at the table on top, you'll see that the dividend yield of the Dow Jones total stock market is 2.07%, whereas the 10-year Treasury is 1.57%. It's pretty rare that the spread is positive in favor of the stock market, and that has always been a good buy signal in the past. If you look at the chart on the bottom, that shows the spread, and you'll see how rare it is since basically 1955 or so, where we have a dividend yield on the market that is greater than the 10-year Treasury. So you invest in a stock, you're getting a higher dividend than you could get interest from a Treasury, plus the equity should be increasing in value over the time. This is the big reason why the market is fairly valued or even undervalued. If you look at the table on top, this is a measure of the difference between the dividend yield for the Dow Jones total stock market. It's at 2.07%, and that yield is greater than the yield you can get on the 10-year Treasury, 1.57%. This is pretty rare when you can make more money investing in a stock where you have the benefits of the stock growing over time and get a better return than the 10-year Treasury in terms of income. So you'll get 2.07% dividend yield versus 1.57% on the Treasury, plus you get all the benefit of the stock growing over the next 10 years. Down below, you can see the spread. This dates back to 1900 actually, and pretty much since 1955, the Treasury yield has always been greater than the dividend yield. So these are pretty rare times right now, and this would indicate why the market is a good value. Another way of looking at it, this is the dividend growth model. This is a relatively simple model to value stocks that pay dividends, and we're going to show here how just a little change in interest rates can make a big difference in what the expected price should be for a stock. So the dividend growth model, the formula is the price should equal next year's dividend divided by the required return on investing in the stock less the expected growth rate. So let's take Coca-Cola as an example. On December 31st, 2015, we're going to assume, and you could look at the numbers, that the dividend over the next year for Coke would be $1.40, and let's assume the required return would be 8.25%, and the expected growth rate for Coke was 5%. You plug all those numbers in, you'll get an anticipated price of $43.07. Actually, the price was $42.96, so it's pretty close. Now let's look at what we think Coke's price should be on July 22nd, 2016. Now the Treasury yield has dropped by 70 basis points since the beginning of the year. Let's keep everything the same except for the required return. The dividend is still going to be $1.40, but now let's drop the required return by only 25 basis points. Before it was 8.25%, now it's going to be 8%. We'll keep the expected growth rate at 5%. So just by changing the required return and dropping it by 25 basis points, the new price comes in at 46.66. So just by the lower interest rates, Coke should be valued by about 8.34% higher. So this shows, this basically is what's happening with the market. As interest rates have declined, the value of equities have gone up. So it really makes sense. This was the slide we posted on April 14th, 2016, and at that time we had a very slight tilt towards the bullish side. That turned out to be a correct call, as the market's been up 4.4% since then. Oil turned out to stabilize, went up a little, it did not become a problem, and then as the market broke through the declining trend line, the technicals also turned favorable. Looking at the market today, we're kind of flat on the market where we think it'll be 3 or 4 months from now. The big thing in its favor, as we explained before, the technicals. We do think there's going to be some kind of run over the next few months. Technicals are so strong. The U.S. economy appears to be in solid shape. Earnings, we think, are going to improve from this point forward. And the dividend yield story, those are all reasons why the market will go up. On the downside, we have the threat of China if they can't keep their currency under control. The presidential race brings a ton of uncertainty into the picture. Possible trade war, we think, will be very detrimental to the economies around the world and the market. Brexit, no one knows really what's going to happen with that. And valuations are stretched based on traditional metrics. The Federal Reserve is going to have to be really careful. We do believe that interest rates need to go up, but that has to happen at a gradual rate. And if the market gets too nervous, that's something that could push everything down. So overall, we're kind of flat on the market from this point forward for the next few months. If anyone has any comments or questions, you're always free to contact us. Our phone number is listed above, or feel free to send us an email. The email addresses are right in front of you. And each week, we have a newsletter. It comes out every Monday.